All right, it is now just after 11 a.m. Eastern, so we will go ahead and get started. My name is Greg Estes, co-director and CIO at MBI, the wealth management subsidiary of accounting firm CBM. We're thrilled you've chosen to spend the next hour with us. Today's session on policy shifts in your money, what's changing and why it matters, is designed to be both practical and insightful. With so much volatility and uncertainty in the current landscape, our goal is to provide clarity on the key issues shaping the economy and what they might mean for you. I am especially excited to introduce our speaker today, Michael Townsend. Mike is Managing Director, Legislative and Regulatory Affairs expert at Schwab. We're grateful for our partnership with Schwab as MBI's custodian, providing the infrastructure, tools, and services we need to manage our clients' investments. Before we dive in, let's go over a few quick housekeeping items. While video and audio are turned off for all attendees, we encourage you to ask questions throughout the presentation. Simply type them into the Q&A tab in your control panel at the top. We'll be monitoring and we'll answer as many questions as possible during the Q&A session at the end. If we run out of time and don't get to your question, don't worry. Our team will follow up with you after the webinar. Today's webinar is being recorded and we'll be sending out the recording along with a copy of the slides to all registrants afterward. So no need to worry if you miss something, you'll be able to review everything at your convenience. One quick reminder, however, if you are joining us through a phone line without displaying your name, please be sure to send us your name and email so we know where to send the slides. We will put our email address in the chat momentarily. So without further ado, I'll pass it over to Mike to kick off the webinar. Mike?
Thanks, Greg, and hi, everybody from downtown DC. It's great to be with you. My name is Mike Townsend, and I'm part of a little team at Charles Schwab. There are 4 of us here in our office, and it's our job to watch what's going on Capitol Hill, in the halls of Congress, at the White House, at the regulatory agencies like the SEC and the Fed, and really just figure out what it all means for individual investors. So that's what I'm going to do today. I do this all the time. I travel all over the country. I do lots and lots of these webinars. Just kind of talking about what's happening in DC. And really, my job is to try to help you cut through all the noise and the nonsense and figure out what's really worth paying attention to. We're obviously in a time, maybe at the most in my whole career, and I've been in Washington for more than 30 years, but the connection between what's going on in Washington from a policy standpoint, having a direct impact on the markets is about as tight a connection as I've ever seen. So that's what I'm going to do today is talk a little bit about the landscape and so what we think is worth paying attention to. So let me share my slides. Hang on just a moment while I get those up and going, and we'll start the presentation there. And I'll start with the lay of the land. I think everybody is aware Republicans have full control in Washington. The Senate is 53 to 47 right now for the Republicans. That's it's a narrow majority. It's nowhere near the 60-vote supermajority you need to really, control the agenda in the Senate, but it's a workable majority for the Republicans. In the House of Representatives right now, it's 220 to 213 for the Republicans with 2 vacancies. There are 2 Democrat congressmen who passed away, unfortunately, in March. Both of those seats are up for special elections, but not until this fall. So I expect that 220 to 213 margin to hold. That's still a really, really narrow margin. I mean, basically, it means that Republicans can't lose more than 3 Republicans on any vote. If they lose 4, then the vote could flip the other way. And that continues to be a headache for Republican leaders. I expect it to be a headache all along, and especially on some of the big policy issues that we'll talk about in just a minute. I want to start from a policy standpoint with the Fed, because I think, as everybody knows, at the most recent meeting in March, the Fed held rates steady for the second consecutive meeting. So they cut rates in 3 meetings in a row, a 50 basis point cut and 2 25 basis point cuts at the end of 2024, But now we have gone 2 straight meetings with no change, holding that rate at 4.25 to 4.5%. And I'm one of those people who reads the statement that the Fed puts out after each monetary policy announcement, and I found it kind of almost humorous how sort of dry the obvious statement was from the Fed, in which they said uncertainty around the economic outlook has increased. Yes, I think that we can all agree to that. And more recently, Fed Chair Jerome Powell gave a speech a week or so ago in which he just flat out said, this is a difficult place for a central bank to be. He talked about the potential pressures in opposite directions on the Fed's dual mandate of full employment and maintaining price stability. That some of the policy announcements, tariffs, and other things have potentially increased inflation risk, and that those two, inflation risk and jobs, could be in tension, which will be a tricky spot for the Fed. But he also said that he feels that the Fed is well positioned to wait for greater clarity before considering any adjustments to our policy stance. And so I think that was a clear sign that we do not expect any rate change at the next meeting, which is coming up in early May, May 6th and 7th. If you follow these sorts of things, the odds of a rate cut are very, very low in May. Futures traders are looking at a 94% chance as of yesterday that there'll be no rate cut. But in terms of where things are headed for the rest of the year, I think that's much harder to predict. There isn't a real consensus on how many potential rate cuts there might be before the end of 2025, again, because the Fed is so data driven and really is waiting for more inputs to kind of figure out what the ramifications from an economic impact standpoint are going to be of some of these policy announcements, tariffs and taxes and other things that we'll talk in more detail about in just a moment. So there's a range of, sort of 2 to 4 cuts before the end of the year. I think at Schwab, we're a little bit on the more conservative end of that, 2 rate cuts, probably not until the second half of the year, probably not until the fall, frankly. No one has a great crystal ball on the Fed. Again, they rely on the data, but certainly something that everyone will be watching. Before I move off the Fed, I'll just make a couple of comments on the most recent kerfuffle that went on this week. When late last week, the president put out a series of social media posts in which he threatened to fire Jerome Powell. That certainly rattled the markets. My own take on that is, and I think the president has backed away from that here in the last couple of days, in which he said he has no intention to fire Jerome Powell. I do think the president likes the sort of, threatening aspect of it. I don't expect the president to follow through on actually trying to fire Jerome Powell. There's real unclarity of whether that's even permissible. It would trigger a huge destabilizing reaction in the market. I think it would trigger a long legal fight that would probably end up ultimately at the Supreme Court. And there are some other things going on with independent agencies that are currently at the Supreme Court on other agencies, and about whether the president can fire leaders of other independent agencies. But I'm not even sure that those directly connect to the Fed because of the specificity with which the Fed was created, decades ago. So I'm not super worried about that, although the market reaction, I think has been indicative that traders are worried about it. The president has backed away from that. I think the president will continue to say that he wishes the Fed would act more quickly, but I don't know that the Fed is going to be particularly influenced by that. Obviously, tariffs is the big policy issue that's driving things right now. And, I have a few bullet points here that just kind of all the back and forth on tariffs, going all the way back to February, when the president first announced the initial set of tariffs on Canada and Mexico. Then he paused them for 30 days. Then he put them in place. Then he backed away from some and then paused some more, but not all. There are still tariffs on imports from Canada and Mexico in place, but they're not quite as widespread or sweeping as they were initially announced. Canada and Mexico have retaliated, of course. We also have sector and product-specific tariffs on steel and aluminum, cars and car parts. There's been talk in the last 48 hours or so that the president may ease back some tariffs on car parts in particular. The car supply chain is, the building of automobiles is so complex, and even sorting out where different parts come from is incredibly hard. It's been said that General Motors itself has 900 suppliers, which then have 18,000 sub-suppliers. So sorting out where things come from and putting the proper tariff on them, I think it's proving to be very, very difficult. We may see some relief there. I think the underrated tariff issue that's going on right now is those 10% across the board minimum tariff on all imports that began on April 5th. Those got kind of lost in the kerfuffle over the reciprocal tariffs. That was the sort of higher tariffs. And if you remember from the Rose Garden announcement, the president had a big chart that he showed with 100 plus countries and what the tariff would be based on the calculation of what their trade barriers are on U.S. imports. Those have all been paused. The reciprocal tariffs were paused on April 9th for 90 days. And that's where you're starting to see signs of country-to-country negotiations. We had talks with Italy. We've had talks with Japan. There's been some talks with India. No trade agreements announced yet, but those conversations and those negotiations have begun. So the reciprocal tariffs kind of got all the attention, but it's that baseline 10% across the board tariff that's still in effect on all imports coming from basically everywhere. I think that's the piece that has gotten a little bit lost in the discussion. That in itself raises our general tariff rate to the highest it's been in close to a century. And so that is going to start to really have an impact. The other piece, of course, that is really huge is the China tariffs. We've escalated the China trade war to the point where we have 145% tariff on imports from China. China has countered with 125% tariff on imports from the U.S. I think we're starting to see, even from the White House, some comments just in the last 48 hours or so, that there is likely to be some easing back from that. I think everybody realizes that that's not a sustainable place to be, and that the impact of that is so far-reaching and has so many tentacles that I do think you're going to start to see some negotiations and potentially some easing back. And the way that things seem to be unfolding, the president seems to be indicating that as conversations get going, as negotiations get going, that's cause for maybe easing back on tariffs. So I think we will start to see more talks between China and the U.S. I do think those tariffs are going to be high and stay high for quite a while on the U.S.-China trade war. But I do think we will see probably in the next couple of months a little bit of an easing back there. Next up, we have semiconductors and pharmaceuticals in the queue for specific tariffs there, and we'll be watching for those. I always feel like I need to remind everyone, tariffs are paid by the importing company. Usually those are passed on to consumers via higher prices. And that's why there's so much talk and uncertainty around what prices will look like, 3 months from now, 6 months from now, 9 months from now, and really why companies are having such a difficult time. We're starting to see companies, as they're doing we're in earnings season now, companies are having a harder time doing their forecasts. And we saw a couple interesting examples. Last week, United Airlines put out 2 different forecasts for the full year earnings and basically said, if things go in a somewhat stable direction, it'll be this. But if we move towards a recession, it'll be this. So I think you're going to see more companies, really trying to provide a lot of flexibility to their guidance as a result of the uncertainty around tariffs and how long they'll stay in place. So obviously the tariffs have had a huge kind of market reaction. I think that's been one of the biggest drivers of the market. And so I just want to show this chart, which I think is really interesting. This chart just looks at the major indices. And you see in the first column there where we are year to date. So all of them down pretty significantly. The second column, though, is where they are relative to their lowest point this year. So there has been, some recovery from the lowest point. The third column there is the percentage decrease from high point to low point for the year. And, the high point, we hit an S&P 500 record on February 19th, which of course was just 2 months ago. So kind of consider that the high point, the drawdown from then. But the real interesting column here, I think, is the last one, because what the last one looks at is the average member of these indices. So S&P 500 has, of course, 500 members. The average member drawdown from their high has been much, much steeper. And what you're seeing is just a lot more sort of movement inside these indexes based on the individual members and how they're doing. NASDAQ, of course, a particularly stark example of that, where we've had tech companies with really, really big moves up and down over the course of the year already. And obviously we're only in April. So I think that's been some of the ramifications of the tariffs and the sort of changing strategy and changing announcements coming out of the White House. As we move forward, I think a lot of attention will move to Congress for this big budget process. So you're going to hear this term budget reconciliation a lot in the coming weeks. It is the parliamentary procedure that's used to pass major tax and budget bills when one party has control of Congress. And the reason that this is so intriguing is that it has a bunch of features that make it really appealing. It has limited debate time, limited amendments, but the most important feature is that bills under these rules can be passed with a simple majority in both the House and the Senate. And what that means is that you cannot filibuster it in the Senate. So you don't need 60-vote supermajority to overcome a filibuster. You can pass it with a simple majority of 51 votes. Now, everything in this bill has to have a direct impact on the budget. You can't have sort of miscellaneous policy provisions that don't have any relation to the budget. And as we go through this process, you'll start to see pushback on whether something has a real revenue impact or an outlay impact. And that's the criteria with which every provision can be included. This in itself is not an odd process. It's not weird that the Republicans are using this. This is the same process Republicans used in 2017 to pass the Tax Cuts and Jobs Act. That was the big tax bill in the first Trump administration. Democrats used it in 2022 to pass the Inflation Reduction Act. It's been used a couple of dozen times over the last 50 years or so. Not at all unusual when one party has control. So the first big step in that is that you have to pass what is known as the budget resolution. It's basically just a blueprint that the House and Senate pass that says, here's the framework for what we want to do. It's a really, really important step, but it is the general step. So what has happened now is that both the House and Senate have passed the budget resolution, and it just has big numbers with no details in it. So that's where you're hearing about the $1.5 trillion minimum that the House wants to see in spending cuts. Some $4+ trillion in tax cuts. But there's a lot of dispute about what the specifics of that will look like. And that's the next step. That's the step that will start here beginning next week in the House of Representatives when the House and Senate return to Washington from the 2-week Easter recess that they're currently on. So you're moving from sort of general outline to specific. Every specific tax cut, every specific spending cut has to be outlined, and that's going to be tricky. So let's start with taxes. The tax cuts that were approved in 2017, that I mentioned, the Tax Cuts and Jobs Act, first year of the first Trump presidency, those all expire at the end of 2025. And that is really the catalyst for this big tax debate, is those expiring. So that's lower individual income tax rates, higher standard deduction, the higher exemption amount for the estate tax, and there are dozens and dozens of other provisions in that bill, all of them set to expire at the end of the year if Congress does nothing. Now, with Republicans in control of both the House and the Senate and the White House, I think the baseline case is that those are going to be extended. The president would like to see them made permanent. I don't know whether the math in the end will work for that. The price tag of just extending them for 10 years is, an estimated $4.6 trillion. Republicans are trying to use a mechanism that will say that those shouldn't count against the budget deficit and the overall cost of the bill, because those are already in place, and what they're talking about is just keeping them going. That's a controversial maneuver. It's going to have to be sorted out in the coming months as to whether they can do that. A lot of people feel it's disguising the true cost of the tax cuts, but that's a fight to be sorted out in the coming months. The reality is, I think the baseline case is that the expiring 2017 tax cuts get extended. The question then becomes, what else gets included in a tax cut bill? And the president made all sorts of promises and proposals on the campaign trail. So that's where you start to hear about things like ending the taxation of tip income, ending the taxation of overtime hours, no taxes on Social Security benefits. The president wants to make interest on auto loans tax deductible. There's a whole bunch of ideas out there. What I'm hearing is that ending the taxes on tip income is the top of the pyramid. That's priority number one, with maybe no taxes on Social Security benefits, kind of just a notch below that. There's been some talk about maybe this bill will include all three of those big things: the tip income, the overtime hours, and the Social Security benefits, having no taxes for 4 years, just to put a sort of finite time period on it. Doing that keeps the cost in terms of revenue loss to the Treasury down. So we'll see. They're on the initial stages of trying to figure that out, but I think a number of these provisions will be added in on top of the other tax provisions that I mentioned earlier. One that's an intriguing fight that's going on inside the Republican Party is the state and local tax deduction, the SALT cap. And that's the cap that was put in 2017 that capped the state and local tax deduction at $10,000. Republicans who represent high tax states, New York, California, New Jersey, a handful of others, this is really, really important to them that cap be raised to some amount higher than $10,000. And the president has endorsed the idea of increasing that. There's been talk about doubling it to 20,000 for married couples. I think a lot of Republicans in high tax states would like to see it go up more than that. But the problem on that one is that incredibly important to Republicans who represent districts in California and New York and other places, and not at all important to the Republicans who represent districts in Kansas and Oklahoma and places like that. It's just not a priority for them. So there's going to have to be some trading off kind of within the Republican Party to sort that out, and I expect that will happen. Members of Congress also have their own ideas above and beyond what the president has suggested. In fact, in the Senate, more than 200 ideas for other tax provisions have been suggested by senators. So this is what they're going to have to sort out, all the specific tax provisions. One that's gotten some attention recently is some Republicans have talked about whether they could or should raise the top income tax rate, maybe make it a millionaire's tax. There's been talk of taking that top rate from 37, where it is now, either back to 39.6 or a little above that to 40. Just this week, the president kind of put his lack of enthusiasm for that, to say the least. It seems unlikely that that's going to be in the mix, but certainly some Republicans are at least still talking about that. And I did want to mention just a couple of thoughts on the nonprofit tax exempt sector, because I think there's been quite a bit of talk around whether changes could come to that could affect charitable giving. I don't see specific broad-based changes necessarily to that, but there is a lot of talk about specific changes to the taxation of endowments. That has been in the mix. There's been talk about changing the tax status of nonprofit hospitals. That's something else that's been a mix. A lot of these ideas came from a list that was put out early this year by the House Budget Committee that was really just here's everything kind of that is in possibly under consideration. And it wasn't prioritized. It was just really a laundry list of 50 plus pages of different tax ideas. And that's, being on that list, and a couple of things I just mentioned were on that list, does not necessarily translate to being in the bill. That was a very preliminary list. So we're going to be watching pretty carefully how things play out for all sorts of different tax sectors and tax provisions. But certainly, the nonprofit sector is one. We've had the high profile fight that's going on between the president and Harvard and other universities, and this kind of talk that, their tax exempt status is going to be revoked. The president can't just wave a pen and, magically take away Harvard's tax exempt status. There's a whole process for that that's pretty time consuming and rigorous. So, that's something that can't be done just all at once. So there's a lot of different moving parts here that we're going to continue to keep an eye on. Another part and one piece of the moving parts, and one that the market really is interested in and always is interested in, is the debt ceiling. So just a reminder, the debt ceiling is the cap on the total amount of debt that the United States can accumulate. It was suspended back in mid-2023 until the beginning of 2025. And once you hit the debt ceiling, and when it came back in January, we were immediately at the debt ceiling. What that means is that the U.S. cannot accumulate any more debt until that debt limit is raised. Now, the government has cash on hand to pay its bills. It just can't continue to borrow until the debt ceiling is raised. So the U.S. can use cash on hand. The Treasury Department has since January been taking what it calls extraordinary measures, not uncommon. They use these different techniques to, frankly, sort of move paper around on the books to make sure that the U.S. doesn't default. But those are temporary and finite. And so Congress is going to have to raise the debt ceiling by sometime in the middle of this year. The April is an interesting time from the debt ceiling because you get tax receipts in on tax day. Reportedly, tax receipts came in very, very high. That's good. That means there's more cash on hand for Treasury and really extends out the period before Congress really hits that deadline to have to raise the debt ceiling. Debt ceiling votes are always tricky. Basically it's saying, we don't have our fiscal house in order. We're going to continue to accumulate more debt. Members of Congress don't like voting for that. However, what they've done this time is they've included an increase in the debt ceiling in that broader budget package. That increase is $5 trillion. The current debt ceiling is around $36 trillion. So if you take it up by $5 trillion, that should take the whole issue off the table until probably well after the 2026 midterms. So that's the way that Congress is planning to deal with this. I think the only question here is this big tax bill is going to take a while. While they're trying to move quickly here in the coming weeks, I think it's going to be well into the summer. I think getting it done by August would be a real success story for the Republicans. And the only question is whether you reach the debt ceiling, that kind of real default date before that bill passes. It looks like that probably won't happen. But markets get a little skittish around the debt ceiling and whether the U.S. will default. The U.S. has never defaulted. Congress has always, no matter how close it has come to defaulting, has always at the last minute passed something. But it is something to just keep in mind for potential increased market volatility, sort of adding to some of the other policy fights that are creating market volatility right now as we move into the summer. The other piece I wanted to mention was government spending, which is obviously a keenly watched topic these days, mostly because of the Department of Government Efficiency, the DOGE. That is Elon Musk's effort to try to slim down the size of the federal government. And basically what it is these little series of teams have gone into agencies across the government, taken control of tech systems and trying to kind of use those to root out, overpayments and fraud and all that kind of stuff. Well, the reality is that the DOGE, of course, has terminated federal employees and cut off funding and gained access to payment systems, all but shut down agencies like the USAID and the Consumer Financial Protection Bureau. A lot of what the DOGE has done has been challenged in court. They've had to pause some things. And, I think there is sort of growing frustration out there, even among Republicans, about the sort of downstream impacts, particularly as members of Congress currently are back in their home states and home districts. the impact not just on federal workers, and I don't want to dismiss the impact on federal workers because that has been very, very, very large. But the downstream impact of that is, federal workers, not just here in Washington, D.C., but in communities all over the country, and then state and local government employees. When you're looking at federal employees make up about 1.5% to 2% of non-farm payrolls. But when you add state and local government employees, that gets you to about 12% of non-farm payrolls. So you're talking about a really potentially big impact on jobs numbers once you add in state and local government employees. And of course, state and local government employees are often, administering federal programs or something like that. And if that federal program goes away, maybe those people start to lose their jobs too. So that's one of the concerns. The impact on the nonprofit in your local community that was dependent on federal funding, the hospital, the university, the college, even companies that are dependent on federal grants, contractors. These are the sort of trickle down effects of this kind of effort to slim down the federal government that I think is going to have real impact in communities across the country. And as members of Congress are home, they're all for cutting government spending until they start to hear how much it's impacting their constituents, the people who vote for them. And we're hearing lots of reports of, very feisty town halls to the point where Republican leaders have told Republican members of Congress not even to hold town halls because they've gotten really an earful. So I'm going to be really watching sort of how the pushback from members of Congress to I think the real frustration is on the sort of haphazard nature of the Doge's efforts to cut the federal government. We've heard high-profile stories about, they inadvertently, fired all the bird flu guys, and then they had to hire them back because there's bird flu going on, or the people guarding nuclear silos, we need those guys back. So there's been that kind of haphazard nature of it, I think has been something that's starting to really frustrate members of Congress who believe in the sort of general idea of reducing waste and that sort of thing in the federal government, but don't like this kind of broad swath of damage that's being caused. So that's really what I'm going to be watching. One other issue I just wanted to mention, it's really hard to overstate what a dramatic turn there has been in Washington in terms of how members of Congress and other policymakers are thinking about cryptocurrency. And one of the things about the cryptocurrency space is that there just isn't any regulatory structure for it. And I think there's real momentum now to creating a kind of regulatory framework for digital assets. We have a presidential working group on digital markets. Both the House and the Senate have subcommittees on digital assets. There's an SEC working group. There's an executive order that has created is looking at creating a strategic Bitcoin reserve and other stockpile of digital assets. So this is just a new focus, very, very different from the previous administration, on sort of making crypto sort of more mainstream, I guess. So there are a couple of bills on Capitol Hill, one focusing on stable coins, which are a certain kind of cryptocurrency that is pegged to the US dollar, and one on sort of the broader regulatory framework to kind of create clarity on who's in charge of the crypto space. Is it the SEC? Is it the Commodity Futures Trading Commission? Put in more investor protections. This is one of the few issues on which there's actually some real bipartisanship in Washington. So something to watch for later this year to see whether Congress can get something that has some bipartisan support on cryptocurrency across the finish line. Finally, I want to finish up with just a couple of fun charts before we take your questions. This is just a one that I think is a really good visual of how things change in Washington. This is a look at all the election years since 1960, and the ones that have yellow boxes around them are the ones in which at least one of the House, Senate, or White House changed from one party to another. So what I want you to notice is that from 1960 to 2000, there were 20 elections. And only 7 times did any one of the House, Senate, or White House flip from one party to another in that election. But in the 13 elections since 2000, it's happened 11 of 13 times. And I certainly think, given the narrow margin in the House of Representatives and the historic trend towards the president's party losing House seats in the first midterm election, I think there's a very good chance that in 2026, the House can flip from Republicans to Democrats, and we'll have another yellow box to add to this chart. Long way to go, of course, until 2026, and a lot can change, and who knows how it's going to play out. But Democrats feel like they have a shot, at least, at taking over the House. This next one just goes at a question I get asked all the time. What is the best political configuration for the markets? So we use the Dow Jones Industrial Average. Annualized performance goes all the way back to early 1900s. And the red arrow there is where we are now, Republican president with a Republican Congress. Dow Jones Industrial Average has been, fairly solid, around 7%. It's not the best configuration. In fact, the best configuration is the one we had in the last years, which was a Democratic president and a split Congress. That's had the best performance. But really important to remember how relatively small the sample sizes are here, and also to keep in mind that while we're in a period right now where the market is being really influenced by policy decisions, historically that's not actually the case. Washington is usually not at all the big driver of market action, but I always think this chart is just interesting. People ask me about it all the time. And then finally, this is just a reminder, these last couple of slides are a reminder of how markets and politics are or are not related. This is a chart that just charts the growth of dollars since the early 1960s across every presidential administration. And, there are ups and downs, but pretty good trend line over time there. And this just is the exact same chart. It layers on who is in control of Congress. So the blue parts are when there was all Democratic Washington, the red parts when there was all Republican Washington, and purple was when there was some split government of one type or another. And again, same good angle line there as a reminder. And so this is what I want to leave you with. If you had invested $10,000 in the early 1960s and only kept it in the market when a Republican was in the White House, you'd have about $100,000 today. If you only kept it in the market when a Democrat was in the White House, you'd have about $625,000 today. But of course, if you kept it in the market the whole time, no matter who was in the White House, you'd have $6.4 million today. So what I want to leave you with is this is an emotional time. It is a very emotional time for investors. You may have really strong feelings about what's going on in Washington, about what's happening in the White House. You may be really happy about it. You may be really frustrated about it. You may be thinking, I've got to move to Portugal, whatever your feeling is. But those emotions are a terrible mix with your investing decisions. And trying to sort of time the market around political developments is never been a successful strategy. So I really urge you to just keep those emotions in check when you are thinking about your investing decisions. Have a conversation with your advisor if you're feeling concerned about what's going on, if you're worried about the direction of things. Having a well-diversified portfolio, broadening your asset allocation. There are lots of things to do when you're feeling kind of emotional that don't involve sort of a knee-jerk reaction. So markets, tend to do their own thing over time. The markets care about earnings, company earnings. They care about the economy. Yes, we're in a time when politics seems to be playing an outsized role in market reactions, but that will probably end at some point in the not too distant future, and we'll get sort of back to the basics. So with that, I will show my little microscopic disclosure slide that I'm required to show, and then I'm going to stop my screen sharing, and we'll take some time with questions. So Greg, I think you've been looking at the questions here. Oh, Greg, you're on mute.
Thought I clicked that. Thank you very much, Mike, for your comprehensive overview of the landscape in DC. As we take a moment to gather some questions, just a reminder, you can enter questions in the Q&A box. We did have some submitted ahead of time. with the registration. And I guess I'll kick it off with and you touched on this, this push and under Doge for cost cutting, whether that's laying people off, talking about trimming or cutting drastically from certain areas of government. One question we would get asked quite frequently is about Social Security. If a person is a current recipient of Social Security, are they going to be impacted by this push for spending cuts? And then maybe what about people that aren't yet receiving Social Security? Is the landscape going to change for them?
Yeah, Greg, it's a great question there. And there are really, as you say, sort of two different angles. So let me take both of them. The first is kind of the immediate situation, which generated some press around a month or so ago when Doge folks got to the Social Security Administration. They're sort of into the systems. And there was worry there that maybe that would impact current benefits. There also were some cuts made to customer service personnel and systems that actually have been a little bit walked back from. But there's concern that that's harder to get your question answered. That if you need to go to a Social Security office to deal with some paperwork or something like that, that maybe that would be more difficult. And I do think there are concerns about the customer service side of things. But benefit checks, I don't expect to be disrupted in any way. I think that would be, if that happened, the outcry from the public, and particularly from members of Congress who are going to hear from the public about it, would be really, really strong. So I think they are going to be careful on making sure that benefit checks, aren't disrupted in any way. The second part, of course, is the longer, sort of larger question of long-term viability of Social Security. And I think, as everybody knows, the math just doesn't work over the long term. And right now, the Social Security trust fund trustees estimate that 2033 is the time frame for when Social Security, if there are no changes made between now and then, will no longer be able to pay out full benefits. Now, it doesn't mean Social Security is running out of money and there'll be no benefits. It just means that that won't be able to pay out 100% of benefits because over time the amount of money coming in is not as big as the amount of money going out. That has been, everyone's known that's coming for a long, long time. We've been talking about this for 20, 25 years, knowing that something had to be done. And Congress knows that. And Congress at some point will get around to doing something. The problem, politically speaking, is that all the choices of what to do about it are kind of politically difficult to vote for. You can raise the retirement age, you can cut benefits, you can raise the amount of income that is taxed, you can raise the payroll tax rate itself. These are all things that are really, really just difficult votes to take. I think we're probably a couple of years, maybe after the 2026 midterms, before you start to really get into a discussion about how to make sure that Social Security is strengthened for the long term. My own personal view, if you just raise the amount of income that is subject to the payroll tax, you solve the problem for decades. And I have no particular crystal ball into this, but I would not be surprised if ultimately that's where things headed. The president has said we're not going to make any cuts to Social Security in the context of larger budget cutting. So we'll obviously continue to monitor that. But I think in the short term, probably not as big maybe worries as some of the headlines have said. And in the longer term, probably a couple of years away from a real debate about the longer term viability of the program.
Excellent. Understood. So another kind of, obviously it's dominating a lot of conversation. I guess I'll start with a kind of a bigger picture question, which is, I think after the election, there was a rally. Now, I've typically told clients that there usually is a somewhat of a mini rally after a presidential election, just because we know who's now in office. But there was a rally, and I think some of it was based on the idea that, hey, we might get lower regulation, cut in regulations, extension of tax cuts, or maybe some new tax cuts. Yes, there was talk about tariffs. We'd known that Trump had talked about them, but we didn't. I guess a lot of people didn't think that was going to be the initial dominant conversation and seemingly the only conversation. So I guess I'll ask it kind of in a short way. When do we get to the good stuff? Like we've been kind of in this tariff mode, which clearly the market is not a fan of. When do we move on from the tariff conversation, if at all?
Yeah, Greg. I think that has been a surprise. It's been a surprise to analysts like me. It's been a surprise to investors, to the markets. The president talked about tariffs. This was not a secret. He talked about tariffs every day on the campaign trail. But I don't think people anticipated the speed, the scope, and frankly, things like the focus right out of the gate on our allies, Canada and Mexico, were the kind of the first targets. I think that was kind of surprising to a lot of people. And, one of the things I think is going to be interesting over, as history looks back on this period is, whether the White House maybe made a mistake in the ordering of how they were doing things. And I think that's kind of the point that you're getting to. I do think there is going to be extensive, deregulatory efforts, but deregulation takes time. And to unwind rules and that sort of thing that can potentially, make things better for companies in whatever field they're in, that takes time. And we'll see, potentially companies will see the benefits of that, quite a bit down the road. Taxes is another example. I think, we're going to see tax cuts. How broad and how many people they affect, I think is still going to be determined in the coming months. But again, we're probably talking, late summer before that happens. And of course, those don't even really kick in until 2026. So there's sort of a lag there. So I do feel like the tariffs have just really been so upfront and kind of immediate that they've taken some of the thunder away from the so-called good stuff that you're seeing. And it's going to be interesting to see whether the president's, approval rating and such can kind of recover from that, because I think the fact that they went out first with the tariffs is something that, they may come to regret over the long term for exactly the reason you're talking about.
And perhaps a decline in approval rating might cause a bit of a pivot, from the president himself,
Well, and
realizing
Greg, I
that.
think we're seeing that, right? I mean, the president, if nothing else, has always been someone who is willing to kind of change the plan midstream, and there's long been a thought that this president is particularly pays particular attention to the stock market and to how things are performing financially. I think all reports of the main reason that the president paused the reciprocal tariffs was because the bond market was reacting really, really wildly to that. And I think he saw that and realized that we needed to get that under control. So I do think the markets play a big role here in sort of influencing some of the decisions.
Yeah, that's an excellent point. I think he even cited that the bond market was getting queasy when he
Queasy,
made
yes.
that made that change. So sticking with the tariffs for just a little bit longer, these change in tariffs that are just announced and then implemented or delayed. Does this all fall under a specific power of the president? Is it executive order? I mean, I thought, Congress has the power of the purse. Have they just kind of delegated this responsibility to the president? How does that work?
Yeah, the short answer to that is kind of yes, that over time, Congress has delegated a lot of the tariff authority, which is quite clearly in Congress's, sphere of responsibility. They have delegated a lot of that authority. And in particular, the president is using various emergency powers that the Congress has granted to the president to be able to use things like tariffs in an emergency situation. So he's taken what I would describe as a very broad interpretation of that. We're sort of in that place where everything's an emergency right now. So whether that's fentanyl or illegal immigration or just national security issues around trade, that he's using those authorities, and there have been some legal challenges to question whether this kind of broad authority being exercised is permissible under those rules. I'm not a lawyer looking into trade law, so we'll see how that plays out in the court. But I do think, you've seen just these small signs that some in Congress would like to take back that authority. There are 7, I think, Senate Republicans on a bill to sort of reassert Congress's authority over tariffs. I don't think that's going to go anywhere, but it is at least notable that there is some frustration on Capitol Hill that and maybe some regret that they've granted away quite a lot of the authority here.
Interesting. So we'll have to stay tuned. We did get a question in, and it's about kind of corporate earnings and kind of the administration's impact on corporate earnings. Obviously, a big one potentially is tariffs, right? Like, passing on or having all these costs for importing, supplies, parts of your finished products, et cetera. What other ways might the administration be impacting corporate earnings? Is there any talk or appetite about a corporate tax cut, or are we just sticking with the individual income tax rates at this point?
Yeah, I think the focus is mostly on individual. There's some talk on the campaign trail on about a corporate tax cut, but I really haven't heard that. In fact, there's some talk of even increasing some aspects of corporate taxes again to kind of pay for other things on the individual side. But to me, the thing that is most notable about earnings season right now is just the uncertainty that companies have. That's really, whether it's tariffs or taxes or regulation, it's just that it's not clear to companies what the landscape is going to be like. And part of that is because the president has imposed tariffs and then paused them and then put them back on and then changed them and that kind of thing. It's just been really difficult, I think, for companies to kind of look out ahead and provide any reasonable guidance about where things are headed, because they don't really know what things are going to be like 3 months, 6 months, 9 months down the road. I think that's where you're seeing the difficulty in corporate earnings. And as I said, we've seen a few companies who have declined to provide, forward-looking forecasts. We've seen companies, like I mentioned, United Airlines, that's done 2 side by side. So I think we're going to continue to see that until there's a sense in the business community that we've sort of got it now. We understand what the landscape is going to be, and we're confident that landscape is going to be consistent for a while going forward.
Understood. And would you think that there would be some sort of tax legislation passed at least before midterms, if not this year?
Well, I think something has to pass this year because of those expiring provisions at the end of this year. And Republicans have the majority in both the House and the Senate. They should be able to get this done. There are a lot of sort of warring factions within the party, the conservatives versus the moderates. So a lot of stuff is going to have to be worked out. But I would be really shocked at this point if nothing happened. And even in that situation, if this big giant bill falls apart or something, I still think you probably in the fall see Congress deal with those expiring tax cuts. So I think the chances of those tax cuts all expiring at the end of the year is very, very low, and Congress will extend them, even if they have to do some emergency thing for a year because they can't get to a final solution. I still think that's pretty likely to happen.
Yeah, that would, yeah, that is a big event, having a big change in kind of a reversion in the tax structure. One of the things topics you mentioned earlier was, possible additions to the tax bill, whether that's an increase in the SALT deduction or what have you. We've gotten some questions that are kind of a variation on SALT. If you were a betting man, if you had to handicap it, what would you think would be the most likely alteration, I guess, or addition to a tax bill?
Well, in terms of the SALT, I think, the sort of lowest hanging fruit probably is to double it for married couples. I think that was, not maybe a mistake that they didn't do that. It's $10,000 whether you're a single or married couple. That's not that common in the tax code that they don't have something like that doubled for married couples. So I'd see that. As I said, it feels like the no tax on tip income is sort of the highest priority. So, if the math just gets really, really difficult, I would see that probably as the most likely of the things that are, sort of floating around out there as the most likely one to be included. I think I'd put that at the top of the list.
Okay, that's good to know. I think there's time for one more question, and it has to do with midterms. So, as you mentioned, in both houses of Congress, there isn't a big Republican majority. It's pretty close. So, as we look towards midterm elections, what does the landscape look like as far as, how many seats are up, for example, in the Senate? Sometimes it seems like it's more in favor of Republicans, sometimes it's more in favor of Democrats. Where does it look to be for the next midterm election as far as maybe a shift in the structure of Congress and who controls Congress?
Yeah, well, I think in the midterm elections, I think the House of Representatives, I think Democrats, all 435 seats are up every 2 years in the House. Democrats only need to flip a handful, I mean, a really small handful, in order to gain the majority. Historically, at least in recent history, the first midterm has been, usually a not very good for the president's party. So I think Democrats have a real good shot to flip the House. I wouldn't think that it would be a landslide sort of situation. Certainly could be, but if they were to pick up 10 seats or something, you flip to the majority there. The Senate actually for Democrats is not a particularly good landscape, even though there are more Republicans up for election, because in the Senate only a third of the Senate is up every 2 years. A third of the 6-year term. So there's only 33 Senate seats, and I think it's 20 Republican and 13 Democrat. I might have that, might have lost that, but it's something close to that. But it's the actual seats that are up are not particularly favorable for Democrats. So of that, there are more Republicans, but most of those Republicans are in very red states where Democrats typically don't have a lot of chance. There are going to be some, close races, I think, for Republican seats in Maine and in North Carolina, but Democrats are defending tough seats in Michigan and Georgia. So, I think Democrats have an uphill climb to capture the Senate. It would really take a much more of a sort of wave type election. And, I don't discount that as a possibility. The president's approval rating has fallen quite a bit since he took office, but where it's going to be, a year plus from now, I think is very, very hard to know. So I think Democrats are pretty optimistic about the House and at least on the surface, certainly being optimistic, but probably behind the scenes, not as optimistic about their chances of taking over the Senate.
So based on the kind of the history then, with respect to the House, it sounds like if you are in a Republican controlled Congress now, you kind of need to make hay while the sun is shining because you're likely to lose control of the House just based on history.
Yeah, I think that's right. And I think that, that's not unusual. You want to get as much done, probably you got about a year from now, because, once you get to late spring, early summer of 2026, you're sort of fully in campaign mode. At that point, it's really hard to get much of anything done in that scenario. So I think Republicans feel like they've got about a year to get as much done as they can.
There's very limited time now between campaign seasons, it seems like,
We're always running a campaign.
Yeah, yeah. Well, Mike, I wanted to thank you very much for your time today, and thank you for kind of trying to make sense of kind of we'll just call it a very interesting and volatile landscape that we're facing right now in DC. I want to thank everyone else for spending time with us today. We hope you found the session valuable and came away with insights to help you navigate today's economic landscape with greater clarity. As a reminder, we'll be sending out slides and a recording shortly, so be sure to check your inbox or spam box. If you have any questions or would like to discuss how these trends may impact your specific situation, we're here to help. Our contact information will be included in the slide deck, and please stay tuned for more webinars and thought leadership on topics that matter to you. Have a great rest of your day, and thank you again.